Right now, most of the world is quietly changing what money actually is, and almost no one is talking about the risk. Over 130 countries, representing 98% of global GDP, are now exploring or building central bank digital currencies. And if you've never heard that term before, here's all you need to know. It's a version of money that the government can program like software. The head of the Bank for International Settlements, the bank that oversees all central banks, actually said this out loud in 2020. He said that with digital currency, central banks will have absolute control on the rules that determine how you can use your money and the technology to enforce it. Think about that for a second. Absolute control. Not some oversight, not a few guardrails. Absolute control over your money. That's not some distant experiment. It's the majority of the world's money system quietly shifting from physical cash you can hold to digital code that can be programmed with rules. It feels convenient until the moment your access to your own money depends on someone else's switch. Who will bear the brunt of the consequences first? You or the generations to come? It's like handing over the keys to your house and hoping the landlord never changes the locks. That reality hit hard in Nigeria in late 2022. During their push toward the e-Naira digital currency, the central bank slapped strict cash withdrawal limits on ATMs and bank branches. Physical notes became scarce. People stood in long lines for hours. Daily transactions stalled, especially for small businesses and workers who relied on cash for everything from food to transport. But this story is bigger than one country's cash crunch. Imagine a man unable to buy medicine for his child because the e-Naira system is down for maintenance. All he wants is simple, reliable access to his own earnings to feed his family and keep his business alive. What stops them? Centralized infrastructure and sudden policy shifts that make cash hard to get while pushing everyone onto digital rails. The price? Disrupted income, lost sales, and the quiet fear that tomorrow your money might not be fully yours to use when you need it most. We've long believed cash is king, anonymous, reliable, always there when systems glitch. Many followed that belief, keeping some physical notes for emergencies, preferring the tangibility of bills in hand. But evidence shows that belief is cracking. As cash infrastructure shrinks and digital options dominate, access becomes conditional. The Nigeria episode wasn't a glitch. It was policy meeting reality. The problem might not be the individual trying to get by. The problem might not be the local bank. It's the deeper shift in how money itself is designed. This pattern repeats. In the UK, bank branches and ATMs have steadily declined for years, even as cash withdrawals still happen, but infrastructure thins. In 2022, the Canadian government invoked emergency powers and, without a single court order, had banks freeze the accounts of 257 people connected to the trucker protests, donors included. $7.8 million gone overnight. A federal court later ruled the whole thing unconstitutional, but by then, the protest was over. The money was already frozen. And in the UK, over 450,000 bank accounts were forcibly closed in a single year, more than 10 times the rate from just a decade ago. Banks are now closing more than 1,000 accounts every single working day. Digital payments surge globally. Transactions leave detailed trails. The same pressures show up in different countries. Declining cash use, expanding digital systems, faster trackability. Many people and businesses now face the same squeeze, not from bad personal choices, but from a coordinated move towards systems where every move can be monitored and directed. And the companies tracking all of that? The data broker industry. Firms like Experian and Axiom that buy and sell your financial behavior is now worth somewhere between $290 and $312 billion. Every swipe, every tap, every digital transaction is a data point that gets packaged and sold. Your spending habits, your routines, your preferences, all of it becomes a product. You don't pay for it in cash. You pay for it in privacy. At its core, a CBDC isn't just digital cash, it's programmable. Rules can be embedded directly into the money, how it's spent, when it expires, who can receive it. What does that mean in practice? Money that can expire, money that only works in certain places, money that can be switched off. Think of it like upgrading from a simple tool to a smart machine with built-in governors. Central authorities gain precision for policy, faster stimulus, targeted aid, or restrictions. But connect that to personal outcomes. Your daily spending becomes data feeding broader ecosystems. Convenience rises, but so does centralized control over access and usage. Now, here's what I want to ask you, especially if you're thinking about what kind of financial world your kids and grandkids are going to inherit. If every dollar becomes programmable, and every transaction becomes a data point, and every account can be frozen without a court order, what actually protects them? Is it enough that the technology is convenient? Or does convenience come at a cost we haven't fully priced in yet? If the trend continues, in 5 to 10 years, cash could become marginal in many places. Fully digital systems would dominate. Under normal times, it might feel seamless. But the twist? The real test comes under stress. Economic crises, political pressure, emergencies. That's when faster intervention mechanisms kick in. What looked like efficiency suddenly enables rapid, scalable restrictions on how money moves. The problem isn't just technology. It's how power concentrates when everything is trackable and rule-bound. Here's the deeper mechanic: misaligned incentives in system design. It's like building roads where the toll booths are controlled by one operator who also sets the speed limits and decides who drives when. Central banks and governments gain tools for stability and policy precision. In economics, that creates structural advantages for control and data generation, while individuals trade privacy and friction for convenience. The feedback loop rewards more digitization and programmability, making reversal harder. The convenience isn't neutral. It quietly rewires the balance between individual access and systemic oversight. So what is the real problem here? Not cash disappearing, but money becoming fully conditional on centralized infrastructure and programmable rules. What assumptions are we accepting without question? That more efficiency and data always serve the public good and safeguards will automatically keep up? Who benefits most from this system? Institutions that gain precise tools for economic steering, faster enforcement, and richer transaction data. If those assumptions prove wrong under stress, what happens? Access constraints spread quickly, behavior gets shaped invisibly, and individual protections lag. The conclusion? We're redesigning the plumbing of society's money in real time. The architecture matters more than the hype. If this shift continues, what should individuals actually do when access to money depends on rules that can change overnight? What does the future look like when every transaction carries visibility and potential restrictions? What is truly changing? Not just how we pay, but the nature of economic freedom and resilience when systems concentrate decision power. This critique naturally focuses on protecting everyday people facing reduced friction in spending, declining cash access, and risks of faster interventions. From the other side, many argue these systems bring real gains: reduced fraud, faster cross-border payments, more effective policy in crises, and efficiency for thin-margin economies. Businesses and tech providers say they deliver tools while choices on pricing, usage, and adoption stay with users and governments. Tipping or digital incentives can sometimes boost earnings. Progress requires balancing innovation with safeguards, not halting it. Events like cash shortages or temporary freezes may fade from headlines, but the underlying incentive structures, programmability, data generation, and concentrated control often remain baked into the new architecture.
The wise approach is steady discipline. Stay aware of how systems evolve, maintain personal buffers where possible, and think long-term about resilience rather than chasing short-term convenience alone. In the end, the architecture of money shapes the boundaries of freedom. Build with eyes open. Because once the foundations are set, changing them gets very expensive. Because once the system is fully built, you don't